Here are the 3 rules of banking. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. We're back for another quick take where today I'm going to be discussing the 3 rules of banking. Rule number 1. So to pay yourself first. Jesse, what does that even mean? Okay, so paying yourself first just means deciding from your cash flows, from your income, an amount. Some folks do that by percentage. Some just have a round number in their mind. You need to start somewhere that's logical for you, reasonable for you, but also significant enough, ambitious enough to actually help you go about the business of becoming your own banker. But that's a number that you have to decide on. That should be based on your current situation. Okay, but also with some forethought for the future. So to pay yourself first just means to pay premiums. To pay premiums into a properly structured whole life policy with a mutual company that pays dividends. Okay, so paying yourself premiums on a monthly, quarterly, semi-annual, or annual basis. Rule number 1. Rule number 2, pay yourself with interest. Okay, so you're picking the number, sure, to pay yourself. But when you're talking about becoming your own banker, see, capital has a cost. If you go to the conventional bank, the commercial bank, you loan money there, you're going to pay an interest. There's going to be lots of other variables to consider as well. You're fronting the collateral if you qualify, etc. But you're going to pay interest. So we should be attributing a cost to our capital. Capital has a cost to it. All right. So we should be paying ourselves, and we should be paying ourselves with interest. When we are accessing capital, when we are loaning ourselves capital from a privatized banking system, or what's really happening in real life is we're taking policy loans against the cash value of our whole life policy. So we're taking policy loans, and to be an honest banker, you should be paying that back and paying it back with interest, because again, we're banking. Okay, capital has a cost, so we're going to pay ourselves back with interest. And then the third rule is to recapture the money. And when I say recapture the money, again, once we realize that everything is financed, either we're using somebody else's money on their terms and conditions, paying them interest, etc., or we are building up money somewhere. Maybe it's at risk. There are things to ask ourselves there in where we're putting it, but we ultimately liquidate it. It's gone forever. We spend it all to do the thing, whatever the thing happens to be, whether it's a vacation, whether it's an education, whether it's a medication, a lot of the shuns, okay, but something in your lifestyle. The difference here is in practicing the infinite banking concept, you can get the money back. What if you could go on vacation and get the money back? What if you could send the kids to college and get the money back? Okay, so answer anything, because this is the infinite banking concept. But what if you could do the thing and get the money back? So when you're the banker, you want to pay yourself first, pay yourself with interest, and recapture the money. And to sum up that recapture the money, that means principal, interest, profits. I mean, where do you want to put your profits? Well, of course, right back into your own privatized banking system. So to be successful in becoming your own banker, you want to pay yourself first, and that should grow and scale over the course of time. Nash would say that you would eventually, over the course of your lifetime, get to where your premiums equal income. Okay. Then if you add in a dividend on top of that, it's even going to surpass your income. But you're going to pay yourself first. You're also going to pay yourself with interest. Capital has a cost to it. If you're going to value the bank's money from borrowing from them, what kind of value do we want to put on our capital if we're going to be banking with our own capital? Capital has a cost to it. Pay yourself with interest. And then ultimately recapture the money. If you're using the infinite banking concept to pay off debts, you're not just paying off debts, you're going to be paying off debts and getting the money back. All the interest that would have gone to somebody else, the return of your principal, of course. And then let's say this is some venture. Let's say this is some endeavor. Let's say you're investing in your business, whatever it is that you're already doing. Well, you're going to be recapturing that now back into your own privatized banking system, because rule number 3 is recapture the money. So I hope that this has been helpful. If you'd like to know more about the infinite banking concept, I encourage you to read Becoming Your Own Banker by R. Nelson Nash. And if you'd like to have a conversation about how to implement the infinite banking concept in your household or your business or your investing, then don't hesitate to reach out to us. And I look forward to that conversation. I hope you have a great day. Take care. Well, to pay yourself for beep.
Oh gosh, Jesse, that was awful fast, wasn't it? Yes, sure it was.
Well, Jesse, perhaps you need to consider slowing it down for the folks in the back. That was quite speedily delivered, was it not?
Then you gotta think fast on your feet, okay? Or you're gonna get left behind, alright? It's just that way. Dog eat dog world out there.
All right.